This is Chris Casey, Managing Director at WindRock Wealth Management, a unique investment advisory firm with a focus on the macroeconomic big picture and an entrepreneurial mindset to seize on opportunities. Today we have the pleasure of being joined by Dr. Joseph Salerno to discuss the war on cash. Dr. Salerno is an academic vice president of Mises Institute, professor of economics at Pace University, and editor of the Quarterly Journal of Austrian Economics. He specializes in monetary theory and policy, comparative economics, in the history of economic thought. Dr. Salerno received his PhD in economics from Rutgers University. His most recent book is Money, Sound and Unsound. Dr. Salerno, thank you for joining us.
It's my pleasure, Chris.
Now, the phrase the war on cash refers to the deliberate actions by governments and central banks to reduce or even eliminate the frequency and size of cash transactions within the economy. Can you describe for us the underlying reasoning for this war on cash that we're experiencing?
Sure. There's the ostensible reason is to stop money laundering, to stop terrorism, which supposedly operates by using cash, to catch tax evaders. Now, all this applies really to developed countries. The underlying reason, I believe, is for the government to keep track of financial transactions, that is, to following and tracking all our financial transactions, basically to spy on the populace. That's one reason. The second reason is to give support to a very unstable banking system, a very fragile banking system, by eventually preventing people from withdrawing cash from the banks. Because when people withdraw cash from the banks, those are bank reserves. So the banks have to reduce the amount of loans that they give out, and they have to reduce the amount of their deposits. So in effect, they want to stop what's called a run on the banks. A run on the banks can cause banks, fractional reserve banks, to close down. They hold up to 10% or a minimum of 10% of our assets in the form of cash, even though they've promised 10 times that to be paid out to their depositors.
And related to the ability to withdraw cash from a bank in order to prop it up, I'd imagine since 2008, we've had this phenomena of negative interest rates across the globe. Banks do not want people to be able to withdraw money because when you're faced with the situation of either withdrawing, of keeping money in a bank and being charged for it or withdrawing it, you prefer the latter. Is that another reason? And if so, what's kind of driving that?
Yeah, that's actually the third reason, and that's becoming more and more prominent, as you mentioned. The quantitative easing policies, the unconventional monetary policies of the Fed and of other governments and central banks have manifestly failed to get the economy moving towards a brisk recovery. So what we're getting is economists and central bank policymakers giving us more of the same. They want to inject more money into the economy. They want to lower interest rates even more. In fact, they want to push them into negative territory, because at that point, then when they're in negative territory, they're paying you to borrow. And so banks will not do that unless they themselves face negative interest rates. So to make a long story short, with negative interest rates, with cash banned, and there are economists who want to ban all cash, you have a situation where even though, let's say, there's a 5% negative interest rate, which means that they are seizing 5% of your deposit on every year, your deposit's shrinking by 5%, people will not be able to withdraw the cash. They have nowhere else to go. So what the policymakers and the economists are hoping is that people will therefore increase their spending, try to get rid of this diminishing this cash with a diminishing nominal amount in their bank accounts, and get rid of it by spending it. And that, according to them, will cause the economy to speed up, to recover. And so it's just really Keynesianism on steroids.
What are some of the different methods? Because we've already kind of touched on the ability of governments just to simply prevent you from withdrawing cash from a bank. What are some of the other methods by which they're diminishing the ability of people to use cash in economic transactions?
Well, reducing the denominations of the bills, that is, making them smaller. For example, in the U.S., by the late 1940s, they had gotten rid of all bills, or they stopped issuing all bills over $100, though they weren't all withdrawn from circulation until the 1960s. And at the same time, when you inflate, the bills that are in existence become worth less and less. So you have to use more of them in the transaction. So for an example, $100 bill today is worth probably about 20 cents or even less compared to what it was worth in the 1960s. So it's basically now you have a $20 bill. So creeping inflation also aids this, or is a part of this war on cash, because it makes it less and less convenient to use cash in transactions. Another thing that we have not done in the United States, but that is done in Europe widely and in Scandinavian countries in particular, and also in Italy, is to put limits on how large any particular cash transaction can be. So, for example, in Switzerland, there's a cap on how large a cash transaction can be, so that you can't buy an expensive Swiss watch or a fancy car in Switzerland all in cash. You would have to go through the banks. In France, I think it's down to 3,500 or 3,000 euros. In Italy, they're trying to push it down to 1,000 euros. So that's another way of doing it. We have not faced that yet in the United States.
And Europe's also using, I know one of the other methods that you touched on with the U.S., and that is phasing out larger denomination bills. I believe the 500 euro bill is being phased out towards the end of 2018. These methods that they're using have been a long time in coming, but it seems like it's accelerated since the 2008 crisis, and we've seen some, at least in academia, some papers, whether it's the book The Curse of Cash by Harvard and Rogoff. You know, I even saw an IMF paper, I think from March of this year, which uses the term decashing as it relates to arguing for worldwide elimination of cash. It seems to me that it's accelerating. Is that your impression as well since the 2008 crisis?
Yes, certainly it is, and for the reason that you gave before, and that is this push towards negative interest rates, this push towards locking cash, locking all money in the banks. So without the withdrawal of cash, you prop up the banks on the one hand, and on the other hand, you can actually push the interest rates into negative territory, because people can only pay for things with their credit cards, debit cards, and other electronic means. There's no way, with no physical cash left, the government can push interest rates as low as it really wants to.
And imagine once you're locked into a bank and you really can't use cash effectively outside of the banking system, you're also subject to what we saw happen in Cyprus in 2012, 2013, where they had, unlike in the 2008 crisis in America, where you had bailouts of the banks, where the government steps in and injects liquidity into the various banks. In Cyprus, you actually had the bail-in, where effectively deposits are seized. What do you see that as a potential in the U.S. or other countries? Do you see that spreading? Is the legal framework already in place as well?
Yeah, I think it is already in place. And actually, I'm not completely against bail-ins. That is what a bail-in is not to pay out, to force, not to make the bondholders whole. That is, not to bail out the bondholders. And also, not to bail out the large depositors, people who have deposits that exceed the insurance limits. I'm certainly not against that. That would give people more of an incentive to watch what the banks are doing, where they're lending. Are they overextended? But now, if they push it to the point where they're seizing the deposits of those who are supposed to be insured, and in the U.S. that's now, I guess, up to $250,000, at that point, they're stealing part of your cash balances. They're stealing part of your cash. But for those people that are bondholders and who hold more than $250,000 in an account in a bank, they certainly know that there's a risk that they won't be bailed out. So a bail-in can be sort of a free market tool, but it is also a tool, of course, of just what I called before a deflationary confiscation, where the government or the central bank actually decreases the money supply by seizing people's money in banks through this bogus bail-in.
Well, let's talk about India, because people are somewhat aware of the developments here and maybe in Europe as far as banning large denomination bills, etc. But in India, we recently witnessed really kind of a draconian example of this. far greater magnitude. Can you describe what's going on there and what the effect has been on the economy?
Yes, in fact, I was just reading an article about it. What they did was overnight, literally overnight, they demonetized 86% of the currency in the form of 1,500 rupee notes, which are respectively equal to about $15 and $7.50, in U.S. dollars. So what that did was it caused people, it forced people to come rushing to the banks to put money in. Now the forecast or the projection was that the people on the black market are not going to redeposit their money. But in fact, 97% of those bills came back and were redeposited. And it turns out that in India, the black market, which is extremely big, it employs up to 46% of the population. And some people have estimated that it actually goes up to 97% of GDP. But in any case, it turns out that really only 6% of money, earned illegally is in terms of cash. The rest is invested in real estate. The rest is invested in stocks. It's in what's called benami assets, which are assets that are purchased in the names of other people. And the other thing is that the reason why India undertook all of this was to catch people who weren't paying their taxes. It's estimated that I think only 1% of Indians' earned income is paid. People pay taxes only about 1% of their income in India. So what was the effect of all this? Well, it seems to tell us the fact that people turned in the money, that the people that had cash and were in the black market found a way to redeposit it to the extent that they did redeposit it without any problem, okay? And the rest, as I said, was really never in cash. So it was all a ploy on the part of the Indian government to begin to get rid of cash, to ban cash.
Do you think we can see something similar to that happen in the U.S.? And if so, would it require a 2008 type crisis for the government and the central bank to act, or do you think this is kind of a natural outgrowth that will eventually arrive, regardless as to an economic crisis?
I think an economic crisis would be the perfect opportunity, right? Never waste a good crisis. Never let a crisis go to waste. That's the motto of politicians. So I think the crisis would open the door to them saying, look, we need negative interest rates. This is an emergency measure, right? Just like bailing out money market mutual funds and bailing out GM was an emergency measure that was brought in by the last crisis. Well, this is a measure that we're going to undertake in order to prevent a financial meltdown and to get the economy going again. So it may be coming in the long run. They're pushing for it, but this would really speed up the movement towards the abolition of cash in the U.S., which would be disastrous.
Well, Dr. Salerno, thanks for joining us today on the War on Cash. It's certainly something that is becoming more prevalent as far as the discussions about it, and obviously the momentum is against citizens holding cash. So we appreciate your time today.
It's my pleasure, Chris. Thanks for having me on.